Hello, everybody, and welcome back. Today, my guest is Richard Kaye from the French asset management company Comgest. Richard is managing the $5.1 billion Comgest Growth Japan Mutual Fund. And today we want to discuss recent developments in Japan. Welcome, Richard.
Thank you very much, Thomas. It's a real pleasure to speak with you and with your clients today.
So, Richard, Japanese equity are considered cheap. And during the last 2 years, the gap between US equity has enlarged. So what are the reasons? Why are Japanese stocks that cheap in international comparison?
Thank you very much. It's a great and a very profound question, which is perhaps the most important question for your clients. Because I think that the cheapness of Japanese equities is a very important opportunity right now. There are two reasons why Japanese equities generally are cheap. The first is that Japan's overall growth this year, 2021, has been lower than the US. The second reason is that Japan is not understood. Let me give a tiny bit more detail on that first point. Japan's growth is slower this year. The only reason for that is that Japan had a better year last year. The comparison effect is more difficult. Japan's coronavirus impact was much smaller last year than the US or Germany or Europe. So its growth looks smaller, but that effect will quickly disappear, probably even this quarter. And on that second point of Japan being misunderstood, that is the basis for my career, basis for my life. The fact that Japan is misunderstood gives us many exciting chances to find great companies which have not been properly valued. And that's why Japan is cheap, and that's why today is an interesting opportunity for Japan.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So Japan is struggling with an aging population and the resulting consequences for the society. So to what extent do opportunities arise from that fact, and how can you benefit as a portfolio manager?
Thank you for the question. And the two things I want to say sort of oppose each other. On the one hand, the aging society is true, and it gives us investment opportunities. Companies like Nihon M&A Center, which is Japan's largest consulting company for M&As, for mergers. And it works with companies run by old people that don't have a successor for their company. We invest in the portfolio also in medical technology companies, which benefit from the aging society. Because they deal with diseases more focused on aging. And many of those Japanese companies have become world leaders. So aging is true, and it gives us opportunities in social change and medical technology. But the second thing I want to say is slightly contrary. Japan is actually getting younger in some ways. If you look at the city population, the urban cities, dwellers, Tokyo, Osaka, Nagoya, actually the birth rate is going up. And also Japan is allowing immigration. You wouldn't think that. And certainly immigration is smaller than in Germany. We don't have Gastarbeiter so much. But actually Japan is starting to allow immigration, and that is making the population younger. Give us 10 years, give us 20 years. And I think some of these population trends will look much more favorable.
So the Japanese stock market is known for its corporate governance issues, and the government of Mr. Abe already tackled this problem in 2012. How is the situation today? Did Japan make progress on the corporate governance side? And how do you think as a portfolio manager on those topics?
Japan has made a lot of progress, Thomas. We're going to show your clients some slides, some presentation slides on the number of external directors for average Japanese companies. We're going to show some slides on the average capital return of Japanese companies, dividend payouts, share buybacks. All of those metrics have gone up steadily for the last 6 or 7 years. Japan is getting better. At the same time, let me remind you and your clients, Thomas, we don't invest in the whole of Japan. There are 4,000 companies listed in Japan. We invest in 35 companies only in our portfolio, the top 1%. And those companies are already doing great governance. They speak our language of shareholder engagement. Many of those companies are still run by the founder family, and they really care about returns, about margins, and about shareholder engagement. So part of the reason that our fund has beaten the index, even beaten the S&P 500 MSCI All Country World Index for 10 years, is we're investing in the best governance in Japan.
In a recent article, you mentioned growth traps in Japan. So what's behind it? How do those growth traps look like?
What's behind it is that Japan is finding a lot of its growth outside of Japan. Japanese companies are finding their growth opportunity in Asia, especially as China, Greater China, grow with population and with improving economy. Japanese companies are finding growth through the supply of technology, brands, medical technology to emerging Asia. But that story is also a trap, because many investors don't realize that actually Japanese companies are deriving most of their profits now from outside of Japan. And so on your first question, why is Japan cheap? Part of the big opportunity is that Japan is cheap because it's not understood. And these growth stories are not well understood.
Japan is considered as a pioneer in environmental technology in Asia. So how do you benefit as a portfolio manager? And can you give us an example of a stock from that industry that you have in your portfolio?
Yes, thank you very much. Just like in Germany, just like in Europe, Japan has a very elevated environmental consciousness. In fact, I would say that Japan's environmental consciousness is even more serious because Japan has more problems. Remember, Japan has no resources. Japan has no oil, no coal, no natural gas. They have to import all their gas on ships, all their oil on ships. It is a resourceless country. Japan also, of course, has a record of problems. The Fukushima disaster, 2011, other industrial disasters in the 1970s. And so Japan has a very elevated environmental consciousness. We invest in that story through Japan's largest renewable energy company. It's a company called Renova, RENOVA. It doesn't sound like a Japanese name, but it is. And they hold solar, wind, geothermal power assets. We also invest in the story through a company called Orix, O-R-I-X, which is the second largest renewable energy company in Japan, directly linked to the government's campaign to grow renewable energy sources because of those national issues that I mentioned.
Especially small and mid caps in Japan are considered under-researched. So how do you deal with this issue from a viewpoint of a portfolio manager?
You're absolutely right. And in fact, most of the alpha that we've generated on our fund over 10 years has been from small caps, small and mid caps, what we call the Japanische Mittelstand, if my German makes sense. The reason that we've made so much alpha is that those companies are not understood and therefore they're cheap. But many of them are great companies. And as we invest in them and their profit growth delivers for us, the share price reflects that. How do we research? The most important thing is we have to be there. We have to be based in Japan. You cannot analyze Japan through a Bloomberg screen or through reading newspapers. And because of our local presence, we're able to meet presidents and founders of companies directly. We get to know them. Some of them become almost our friends. And that gives us the confidence to invest in these companies for the long term. And they make great alpha for us.
One final question for you, Richard. So there is an ongoing discussion about potential style rotation from growth to value. Your fund is labeled growth fund. So why is growth still a great idea for investing in Japan?
This has been a difficult year for us, Thomas, because of that style rotation, especially the months of February and March were hit by that style rotation, the rotation into what people call value stocks. But I'll be very frank, a British guy, I speak very honestly. I think that value investing is despair investing. It's investing in the belief that there is no growth left. It's investing in companies that you don't think are great, but you think they're cheap, and you hope someone else is going to buy them at a bigger price, even though they're not great companies. We don't do that. We invest in companies that we think are great and will grow and do unique things and speak shareholders' language. And that meant that in February and March this year, we suffered from this rotation to so-called value. I don't call those stocks value. If you look at our performance since May, we've actually outperformed again. The market has returned to our approach, to our process of favoring great companies that are growing. And we believe that the Japanese market over the long term will continue to reflect that approach. One final point I want to leave you with, Japan is buying Japan. Japanese institutional investors are buying their own market today. What are they buying? They're buying engagement. They're buying capital discipline. They're buying quality. They're not buying cheap stuff. And that's why we think that our growth quality approach will win in this market.
So this was Richard Kaye from Comgest on Japanese equities. Thank you very much, Richard, for being with us today and sharing your insights.
Thank you very much, too. Pleasure.